So friends, we're going to talk about supply demand, and we can also call them order block. I'm going to tell you why I like this name so much, and of course about imbalances, because imbalances are something very fundamental for our supply and demand. I know there are thousands of versions on how to draw supply demand properly and so on. I'm going to explain you in this video the only way on how we use supply demands. And even if you are an experienced trader and you know exactly how to draw them, take a look on this video because probably you will learn something new out of it. As you all know, I like to present you all the concepts that the majority knows in a total different light, and therefore this will enhance in reality your trading, because we are here advanced, super refined, smart money concept traders. I mean, I don't really like this word because, yeah, I mean, smart money concepts trading should actually mean we trade like institutions, okay? Problem is that the majority of the SMC traders do not trade like institutions. And this is what I try to explain you right now here with every single concept that we have, because we truly do it because we truly understand what the concepts are about. And when it comes to supply, demand, and order block, already the name is super important for us to understand, because this is why I like both names. Okay, I like order blocks a lot because order blocks describes what? A block of orders, right? So if you have here this and you have here this, so you have two blocks, one for sells and one for buys. That's how you need to understand it. And these blocks are everywhere in the market. When we look to the past, we know where they've been, okay, because we have the data. But when it comes to the future, you see just a blank chart, right? So you don't see anything. You just need to admit, what could be the possibilities, right? So just to understand what an order block is, it is an order in the market. So price is first pushing down, then it's meeting the order block, and price will suddenly start to move up higher and higher and higher and higher and higher until it will meet another order block, which is in this case a sell limit block, and price will then just start to move crazy to the downside. And this is the definition of an order block in reality. We also use the name supply zone at the top and demand zone at the bottom, but that means at a demand area you should buy, right? A demand area is responsible for a buy movement, and a supply is responsible for a sell movement. Okay, this is why I like to use supply demand also as a definition for it, because this way I know exactly, okay, I'm going to sell at supply zone, so I know, okay, I need to sell at supply zone. Okay, so the name itself is pretty nice. And yeah, that's the very basic, the basic from the basic right now. That's what we need to understand. The next thing that we need to understand about supply demand is on how to validate them. What is the definition right now for a supply or a demand area? Let's start with the demand zone. So we have here a clean situation. You see price is giving a sell candle. Furthermore, what we could understand from this context is that price is moving down, right? It's moving down. That's what we just discovered here when I made this description here. So price is trending down, and then it's making the last sell candle before a strong up move candle. And that up move candle is doing what? It's breaking the sell candle. Now, that doesn't need to be always the case. Okay, it doesn't need to always be in this context that price need to go like crazy here. It is also enough if the wick is only above. You will see this is not the true definition of a supply demand, how the candles will look like, if the wick will be here higher, if the body is lower, blah, blah, blah. Okay, doesn't really matter. What matters for us is that we have three candles. We want to have three candles. We have a sell candle and we have two buy candles. Now that is also not enough. What we want to see is that we have an imbalance. An imbalance is when two wicks are not meeting. So the first candle and the third candle, these two wicks are not meeting with each other. And what they do is they're leaving in the market this area. And this area is an imbalance. And that means for us, price is inefficient. So the algo, that's the task of the algo, needs to go and needs to fill in this gap to provide a fair market. What is a fair market? Why is an imbalance here to get filled? Why is it then a fair market? Well, you need to understand that an order block, like we already identified, are footprints of the institutions. So when this block is going to be active, whether it is a buy limit or a sell limit, price will rapidly start to move in the opposite direction than it was. Okay? Not always, because you can also have order blocks here, like price is just moving, and you could have order block here, order block here. But of course, first of all, it will give you a move down if it's a demand zone and then push up, or it will give you a move up before it will move down. And because of the order block is active, the price will just start to move strongly in one direction, and that move will leave, in most of the cases, an imbalance. So if it is the true intention of the market to bring it, like in this case in the demand area, wants to bring it to the upside, if that is the true intention of the market, it will leave you with an imbalance because they filled in so many orders, because they liquidated earlier on with the movement to the downside. They gave you the intention that price will move down forever, and then at some point they are able to fill in their orders, and the price will just start to move rapidly to the upside, but moving that fast that it cannot provide a fair market, which means at the imbalance, at these transactional points, nobody was able to take a trade. So the market is not fairly delivered. And that means the task of the algo is to bring the price somewhere in the future back to this point to provide a fair market. This is just something which is not always true. So do not expect right now that all imbalances will get filled. Why? Because you will see later on that the context is important where the price is. So the market cannot always be fairly delivered, because you need to understand a price could move many years to the downside and leaving imbalances, and then somewhere in 10 years it will come and it will fill in the imbalance, and then it is also a fair market. So let's say here is the imbalance and price will come and fill in the imbalance, but only 10 years later. This is still a valid and fair market at the end, okay? So you see the aspect time isn't for the algo right now that relevant. So this is why for us the context will be relevant, and I will explain you in the further videos on how to use that and how to validate then when an imbalance will get filled and when not, okay? So back to the understanding of a supply demand. We understand right now imbalances needs to get filled. That's like for us the number one reason why price should return into the direction of the demand zone. Because exactly where the demand zone starts, okay, this is how the demand zone looks like. So the last bearish candle before the up move. So this area here is the valid demand zone, and exactly where the imbalances ends, the imbalance zone where it ends, the demand zone starts. Okay. Now there are traders, who think, yeah, I need to trade only like this. I just need to put my buy limit at the beginning of the imbalance and stop loss where the demand zone starts. We're not going to do this. Very important, because yes, we also understand that only the imbalances needs to get filled and not really the demand zone needs to be touched. But there is a conflict. And the conflict is that the demand zones need to get touched because that's the interest of the institution. Okay? So one more time. The institutions do want to have a touch at the order block and at the supply demand. The algo only wants a touch at the imbalance. So who do you think will win? Well, ideally both. Okay? Sometimes only the algo. And this is the point. We cannot only use the imbalance because we know the algo only wants to fill in the imbalance, because that's simply something which will not always be the case. More than likely, in all the cases, or in majority of the cases, the market will hit a supply or a demand before it will move up. And we will never trade off of imbalances. We will just admit that the imbalances got filled, and we have then other entry possibilities if imbalances get filled. You will see that also later on in the course. But for now, we need to understand we only trade off of demand areas only if the price will touch the demand area. This is how the concept works. So why do the institutions do want to have the price touching the demand zone? I thought that they want to go long, right? They want to push price forever up. Not really. Not really. Why? What do you think? What kind of positions do this institution has, who is pushing price now here all the way back up? Both. That's what many people forget about. They have sell positions opened up, but also buying positions are opened up. I mean, they're constantly buying and selling the whole market. We know that, and only with the right risk management, they will be then profitable. But for us, important is you also need to view every concept that we have also in the context. And the context of the supply demand means pretty simple. When we are pushing from a demand zone, they have the majority of the positions for this up move on long, and they have a small portion which are on sell. What they will do is, because in order for them to get long positions, in order for them to fill in their buy limit positions, they need people who are ready to sell. This is why these zones are also called supply demand. Okay? So that means right now, let me just move this a little bit on. Oops. So that means right now, if price is pushing up from a demand area, it can only push up because many people got trapped. Okay, so this is a source of liquidity here. Many traders got trapped. And many traders thought about, hey, we got supply zones, right? They thought about price will move down forever. They thought supply to supply, supply. And then suddenly, they have so many people on shorts that they can just activate their strong up move. But within the last down move candle, they need to bring price one more time to the downside. And that means they have sell positions here. They have sell position here, 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 till this point here. And at the lowest low possible, of course, this is where they have their long. This is why we can use here the concept of structure. So if you refer then to this example here, you will see exactly how our price starts to move on. We know there was an order block. So specifically at this line, this was where they initiated their first long position. They initiated here the first long position. So we know from here the price started to move up. And we know from here to the downside, they initiated a short. And they initiated the short in order to trap people, to take out the liquidity from here, and then to push price up higher and to take out liquidity from there. So supply demand is just a liquidity grab price action at the end. You can see it already here. This is the movement. Move down, liquidating people who are ready to buy, liquidating but also people who think it will still continue to go short by pushing price up higher. That's what they really do. So they leave here the imbalance. Here you have the imbalance between And ideally, they also leave liquidity, which is in this case this one, right? And the reason why they want to come down is only because they want to stake their long position. So in this example here, they want to bring price back down because they want to get rid of their sell positions. They want to close, but also buy again the market, and their target will be at least the previous high, what they created already with the demand. That's what you can expect at least. So if this is a true and valid demand area, this is the form of the price action that it will represent you every single time. So again, price is moving down to take out people so that they can buy the market, pushing it up that strongly because they absorb the full liquidity, and that will lead to an imbalance because they're just absorbing the liquidity, and nobody can buy the market at the imbalance at that time, and this is why it leaves the imbalance. So at these prices, nobody can buy or sell the market. This is why the price is not fairly delivered. Price continues to move up higher, but they need to press the sell bottom again, and by pressing the sell bottom, they are creating here another supply area, okay? Or not. That depends then again on every single individual situation. But more than likely, because if price is moving down, they're creating a supply zone. But with the target, actually, if this is a valid demand, they will target here the high. And this is why sometimes this is a supply zone. Supply zones do not work because they appear to be supply zones, but there aren't supply zones, or there aren't supply zones where the intention of the institution is to bring price then further to the downside. Okay. I will explain that then on this example. But just to remember, last selling candle before the up move, and they want to make this mitigation, because that's the word. Mitigation is the word for them closing their short positions around break even. So they will not always be able to close all these positions at break even because they will also have sell positions down here. They will not always mitigate everything till the low. It's also not really good to always see price mitigating till the low, because that will leave then automatically another source of liquidity, which are equal lows, depending on how it is doing. If they are really mitigating of always the beginning of the demand zone, that will not even leave a liquidity source, right? So that means the intention is probably to really push price up crazy to the upside. But like I said, this will always depend on every single individual situation that you will see then in the market. But for us, very important is just to understand how a supply or demand zone looks like. Is in a demand zone perspective is the last down candle before a strong up move, having some imbalance, and price will need to return because they want to fill in the imbalance, but also the institutions want to get rid of the sell positions and they want to buy, of course, some more. And this is how then afterwards order flow will be get developed. Okay, we will speak then in the next video about order flow. So let's just have a look quick on supply zone, the same kind of thing. Last up move candle before the down move candle, you have the imbalance because this and this is not meeting. It's not a fair delivered market, and this here will act also in the future as a source of liquidity because price will move like this, will touch this, will mitigate, and then you expect price to continue with the trend. Here early on, what you've seen is a BOS, right, of the candle on a lower time frame. If this is, for instance, the 4 hours what we map out, you will see price here moving like this. Boom. You will see there a clean BOS, and you can then see the same kind of price action where price is moving down, breaking structure, reacting from a supply zone, and continue to move down. That was represented in just one candle because that's the higher time frame. And this is why the whole market is always fractal, because on every single time frame you will see the same kind of things. Okay? So if we have a look right now here on this example, we understand price started to move up crazy, taking out liquidity on both sides, leaving you with this. And that's what we want to see always for our demand zones, because we do not really want to just take demand zones itself. We would like to see price liquidating people, and people are looking at this because it's a form of structure. This is a form of structure. People would say this is a support area. And this is exactly why we're going to use these kind of lows, higher lows, as some source of liquidity in order for us to hunt them and then to go long. Because the thing is, people bought in the past here because they seen this up move and they bought that. And then at some point, it will reverse and this will go against them because we want to take out everybody out of the market. So this is where price will always go step by step higher. And this is order flow. Order flow means that the price will go step by step higher and higher if this is the true market intention to go. If it really wants to go up, it will develop on all the way up order flow. But we will speak about this concept in a separate video, as we can speak a lot about this concept as well. But us, for now, what we need to understand, the whole market can be interpreted by normal supply and demand. How can a supply demand also look like? For instance, this can be also supply. You see 2 wicks, like here, that could be a form of supply. Are we interested in these form of supply zones? Well, not always, but sometimes they make sense. But very rarely they do make sense. It just, of course, again, depends on the overall market situation. But you can remember whenever you see these kind of things, they could work. Why? Because you have imbalance in these kind of things also. So of course you need to have imbalance. If you do not even have imbalance, then this is of course not even valid. But personally, I would not focus on these type of supply and demand zones. I would always focus on these type of supply and demand zones because those are those ones who really work. Okay? One more time, what I want to illustrate you is that this up move candle on a lower time frame, they'll look something like this. Strong up move, and then it's cracking down. Because the basic understanding of it is that price is creating a bullish market at that time. People think price will go up forever. And then they're initiating from here till here a strong buy order. And with this buy order, they make pure excitement in the market. People think it will move down and will go one more time up higher, right? Because we have the trend line and so on. But what they will do is they will hunt all the liquidity, will give you a pullback, then people will think, okay, it will go from this structure level to the upside, but then it will totally go against them. And in the future, then also what you will do, because what we do on the supply demand areas, we do refine them on the lower time frames. That means here on the lower time frame, we will have another supply zone. And this one will act as liquidity. And this is how it will look like then. This is why we will refine. We start also here with a higher time frame analysis. That means what I like to do from a intraday perspective, I only like to maximum take the 4 hours, right? 4 hour supply demand zones are for me relevant. Of course, I also look on the monthly, on the weekly, because the monthly, the weekly will, and the daily, they will show me overall trend continuations or pullbacks, whatever I can expect. But the 4 hours are important for me then to refine at least to the 4 hours. And when it comes to the 4 hours, I have this big zone. I don't like to trade off of these big zones, and I want to have clean confirmations inside them. So this is the next time frame that I always use, is the M15. The M15 is then that small, and within the M15 I can repeat the same story, and I can see that M1 supply zones, and when price is going to come all the way back up till the M1, this is where I'm going to then monitorize price action for my entry confirmation, or I will use strict risk type of entries because I already understand where the liquidity is. Super nice and important is also to understand that whenever we want to take a trade on a supply demand, we would like to see some form of liquidity getting built up. In this case, this is my liquidity. You've seen here this move, so it's not really close, or it is close to it, but it's not touching it. That's what's relevant. And then I expect price to run that high because we know above highs there's liquidity. So after the price is hitting that liquidity and it's mitigating and it is in the refined area at these points, I'm interested in taking that short. And then we can expect price to go down lower. Okay, so this is the very basics right now and the clean theory understanding of supply demand order blocks and imbalances. We will go then in the next video more over the practice. I will explain you a lot of things on how we really draw them down, how it looks in the practice, because theory is always, I would say everything is easy in theory, but when it comes then to really look on specific scenarios, it will be a little bit trickier for the majority. And then, of course, when we need to combine everything together. But for now, I hope that this is clean. Shouldn't be too difficult. Just make sure that you understand the basic rules of it. Like I said again, sell or buy candle before the real original movement. Then imbalance needs to be left over, and then you expect price to return to these areas. You refine these areas to the lower time frames, and also there you look for the same principle. You also look there for a clean imbalance in the lower time frames as well, and there you look for your entry. Okay. What also people like to use is to just like use 50% of the block. Personally, I'm not a fan of that too much. Why? Because I like to just go down on the lower time frames, and I have done anyway my order block that I would like to trade from, and this is why it's not really required to use the 50% tool anymore. Maybe if you are on the lower time frames and the area is still too big, then you can use that. Or what you can do is you just use the wicks, right? You just draw the wicks if the whole order block is already too big. Okay.